Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. I've been doing an experiment lately where I've been paper trading earnings plays. And all I've been doing is selling options in a way that take advantage of the drop in volatility after an earnings announcement. And, I've just went through every day in a paper trade account and sold options on that earnings play. And every day, just doing that over the course of, a few weeks. And I've got a few trades up now, and I think I've done enough for my experiment to, be concluded, and I'm happy with the results. So it informs me that I've learned something out of this, and hopefully you will too, because I think the results are pretty interesting. And we're going to talk about it and look through the results, see if we get anything out of this that make us better investors. But before we get into the results of my little experiment, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and document my own journey towards financial independence. So if you like this video or get anything out of it, I'd really appreciate a thumbs up, and you can subscribe to the channel too if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. Before we get into the results of my little experiment that I did, let's back up a little bit and talk about how options are priced. Options are made up of three different things. There's intrinsic value, which is how much value the option is in the money, above or below its strike price, and that's what it'll be worth at expiration. And then there's the extrinsic value, which is made up of two things, which is time, depending on how long it has to expiration, and there's implied volatility, just how volatile they think that the stock is at the time. Now, implied volatility rises before an earnings announcement. That means the options price will rise. And the reason it does this is because no one knows what the earnings announcement's going to be, if it's going to be good or bad. So there's uncertainty, and that increases the implied volatility. Then, after the earnings announcement, the news is out, and that implied volatility will reduce and drop because now we know what the news is. Shares may go up, shares may go down, or they may stay sideways, but we do know the end result. So here's a chart of Tesla, and on the top we have the share price, and on the bottom we have volatility. And the little green dot there is their earnings announcement. And then when they announce their earnings, we can see the blue line that drops, and that blue line is volatility. Now we want to sell this blue line and then buy it back after that big dip after the earnings announcement. That's the idea. This is called IV crush. And if you're an options buyer, that's a bad thing because options prices go down. And if you're an option seller, it's a good thing because option prices go down. And there's a few different strategies that we can use to take advantage of this. We want something that can kind of just capture that decrease in volatility. We don't want to bet on the stock going up or down because we don't know. And one of these strategies is a short straddle. All you're doing is you're selling a call and a put. You're selling them both at the money, which means the option contract that's closest to the current stock price. And you're going to sell this on the nearest expiration. Hopefully it'll be like the weekly expiration. This is what a short straddle looks like. So we'll sell the $75 put and the $75 call, and we'll just say, we get about $2.50 each, so that's $5. We'll get a total of $5 in credit. And these little blue lines, as long as the share price stays within a $5 range of $75, that's the current strike price and the current share price, as long as it doesn't go too far, like $5 out, then this should be a profitable trade. So we want to get as much premium as we can while not having any directional risk. And these are kind of scary because there's always going to be one of these that are in the money. Either the put or the call. One of them is usually, it has to be in the money unless it's like at a perfect $75. Here's the list of all the stocks that I did earnings plays on. Now I sold a short straddle on all of these stocks at this strike price. At the time of, putting on the earnings trade, this was the nearest strike to the current share price. I got 22 stocks here, and then every day, I would just put on a new trade. So PayPal came up, and I sold a straddle for $190 strike price. And then Google, actually, I think Google and Amazon, and I think I did iron butterflies for these. And essentially that is, I just bought protection on the outside wings, so it was a defined risk trade instead of an undefined risk trade with everything else. Just because even with my paper trade account, it's really hard to sell, a naked position on Google. Google would be $155,000, and then Amazon would be $319,000. So I just kind of defined my risk on a couple of these. But everything else is a short straddle on the strike prices. I sold the option before the earnings announcement, the day before, and then I bought to close as soon as the day after the earnings announcement. And these are my results. So look at, say, PayPal up here. I sold the straddle for $190 strike price. And when I sold it, I got $12 in premium. Then the next day, there was that decline in implied volatility. So I could buy it back for $10.51. And I made $1.49 doing that. So total would be like $149 off that trade. And, we got a few winners and a few losers. So if we add up all the premium that I sold and, the premium I lost, I would make $2,196 if I'd sold all these contracts with 13 winners, 9 losers. And my average win was 0.045%. And that's for one day in the position. And what's interesting about this, I think, is that if we annualize that, we only get 16.4% annualized. And 16% annualized, really isn't that great. Especially when you consider that I got 13 winners and 9 losers, and there's not really a big difference in the amount of winners. It isn't like I had 80% winners and 20% losers. It's 13 and 9, which isn't that great. But there's one thing that kind of stands out in my little experiment here, and that is Tesla. Tesla had a really good quarter, and they shot up a bunch, and their volatility dropped a whole bunch. So most of my net returns are like $1, 90 cents, 20 cents, 60 cents, and Tesla is $18.45. Even my other big high-priced options like Amazon, I lost 80 cents on that. And then the other one, Google, I lost $3.80 on that. But with Tesla, I made $18.45, and that's a bit of an outlier. So if we look at this, our $2,196, $18.45 of that is Tesla. Now, if we imagine we didn't make that Tesla trade, then our average, our net gain, we'd only make $351 out of these 21 trades. So we'd have 12 winners and 9 losers, and we'd only make $351. Now, I know it's like a smaller sample size, and Tasty Trade can do earnings trades on thousands of earnings plays over the course of a decade. But Option Alpha also did a study about earnings plays, and they kind of found the same thing, that you don't really have any statistical advantage on doing earnings plays. And with my 23 trades, if I would have, put my money into these trades, I wouldn't really make that much. I'd have took a lot of risk, and I wouldn't really made very much money off of that. Not worth the risk, I think. So yeah, it doesn't really instill me with confidence to do earnings trades. I also could try to do different strategies. These were all selling short straddles. There's also strangles, and maybe you could sell just puts or calls. There's different strategies that I could try, but with my little experiment selling the short straddles, I'm not really happy with the results, and I probably won't, really do earnings trades, because I don't think, I'm not convinced that they will work in the long run. So leave a comment down below. Do you do earnings trades like this? What's your strategy? Are you selling straddles? Are you selling strangles? What are you doing, and how consistently have you been able to make profit doing these? But yep, if you get anything out of this video, really appreciate a thumbs up. Go ahead to subscribe to my channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. I'll put some more videos over here that we can watch, and then I want you to go have a good day, all right? Justin out.